case studies from sell-side advisors. So looking forward to getting to that discussion, but before we do have a few housekeeping things that I want to address. If you're not familiar with who I am, my name is Lena Dobrier. I'm the Director of Operations at Opus Connect. We are a lower middle and middle market M&A focused organization. We cater to private equity firms, investment bankers, independent sponsors, etc. We have chapters in LA, Chicago, and New York, where typically we'd be gathering in each of those markets once a month for a roundtable or a panel. And in addition to those events, we do deal sourcing events, again, typically all around the country, but currently everything is virtual. I think many of you are going to be participating in our Atlanta-based Deal Connect today virtually, so looking forward to that later on as well. If you're interested in learning a little bit more about Opus Connect, who we are, how we can help, feel free to reach out to my colleague, Jacob Zephyrin. His contact information is below, and he'd be happy to answer any questions that you might have. If you have questions during the discussion today, our moderator, Jonathan, will be monitoring those. There's a bubble at the bottom of your screen labeled Q&A. Go ahead and submit your written questions there, and we'll try to address as many as we can. These events, of course, would not be possible without the support of our sponsors. So I definitely, especially this time, want to give them an opportunity to say a few words. Steve, I see you, and we're going to go to you, sir. Go ahead and introduce yourself and your firm.
Thanks so much, Lena. Can you hear me okay?
Yep.
Okay, great. Thanks all. I'm Steve Finder. I'm with Focus Search Partners. We're a boutique but national retained executive search firm with offices around the US and a large parent company, so we're well resourced. We focus on helping portfolio companies of private equity firms with senior level and mid-level hiring. We cover technology, industrial, healthcare, and business services, and a little bit of consumer. So that's the high level. Look forward to today and look forward to getting to know all of you in the coming days. Thank you.
Thank you, Steve. Next, we have Polsinelli. Jonathan Kendall of Polsinelli is going to be moderating today. So before we have him introduce himself and today's topic and panel, we do want to ask a question here. If everyone can participate, we'd like to know which best describes you. So we're going to launch that question here in just a second. Marisol, I'll do it on my end. And of course, that's the wrong one. One moment, bear with me. Virtual difficulties. Which of the below best describes you? Independent sponsor, investment banker. I would presume we're going to have a good amount of investment bankers and capital providers today, given the one-on-one meetings later this afternoon, but go ahead and submit your answers there. We'll give it another 15 seconds and then we'll get to the discussion. Don't be shy. Okay. So 6% independent sponsors, good percentage, 56% investment bankers. No one on the debt side, it seems, or maybe you just didn't select your answer, but 6% on the capital provider side. So that's great. Thank you all for participating. And without further ado, I would like to introduce today's moderator, Jonathan Kendall of Polsinelli. Jonathan, take it away.
Thank you so much. Again, I'm Jonathan Kendall. I go by John. Welcome to today's discussion. I think it'll be a productive talk about what we're seeing in the market and how we can get some of these deals to close in this strange time. First of all, I'm an attorney with Polsinelli. Polsinelli is a large law firm. We're a full service Am Law 100, about 900 attorneys. I want to go ahead and skip past that. No one wants to hear about the attorneys. We're here to hear about from the investment guys. So why don't I go ahead, guys, and Ira, why don't you go ahead and introduce yourself to the group?
I am Ira Leiderman. I'm head up the healthcare banking effort at Cassel, Salpeter. We are a middle market primarily M&A boutique based in Miami. We're small with 13 professionals, been in business a little over 10 years, and we have 3 senior bankers in the healthcare space. In addition, we do work in aviation and packaged goods, consumer products, and food.
Thanks, Ira. Who's next on the list, Lena? I'm sorry, I didn't know they were in order. Just
No problem, it's fine. Let's start with Michael, go ahead.
Hey, good morning, everybody. My name is Michael Poole. I'm a founder and investment banker at PCE. Also a mid-market boutique investment bank, national coverage. We've got 4 offices, Winter Park, Florida, Atlanta, Chicago, and New York. About 20 folks and varied industry coverage.
great. Thanks, Mike. Go ahead, Josh.
Hey, I'm Josh Mastracci. I'm Vice President at Hyde Park Capital. Like the rest of the bankers on the panel, Hyde Park's a middle market boutique. We're based in Tampa, second office in Atlanta. Sector coverages are technology, healthcare, and services predominantly, with a focus from an earnings perspective on businesses, founder family run, 5 to 50 of earnings.
Good morning, everyone. My name is Christian Given. I lead business development efforts at Croft and Bender. We too are a boutique investment bank focused on M&A advisory. We have 22 professionals based in Atlanta, Georgia, and focusing on transactions called 30 to 300 million of enterprise value. And we are industry agnostic, if you will, but have a specific focus in the industrials, healthcare, business services, tech-enabled services and software, and consumer services sectors.
Great. Thanks, guys. So in order to get to a close, you've got to get the deal. So I'd like you guys' thoughts on how maybe the process has changed a bit in this time and where you're seeing the business development efforts currently.
Maybe I'll start and we can run it down the line here. I think what we've seen change is, we've signed up several clients now over the past 6 or so months that we've never met in person, which is, if you would have told me that, this same time last year, I would think that the possibility of doing so would be slim to none. We typically like to travel and get FaceTime with clients before signing up new mandates, but that's really changed for us in our kind of embrace, and the industry's embrace of teleconferencing has allowed us to operate without the need to travel. So it's been good for continued workflow despite some of the travel restrictions.
That makes sense. Mike, what are you seeing?
Very similar to Josh. It is surprising that signing up a client without meeting in person, but that's becoming more the norm than not. For a relationship person like myself who grew up in banking, it's not comfortable because I'd like to feel in touch, get much better sense of the owner's decision making in the process. A little scarier, and making sure that the client's going to follow through with a mandate and sell. And so it's hard to get the measure of someone all the time through a Zoom call or a conference call without meeting in person and spending time with them. But right now, that's the industry.
How about you, Ira?
Yeah, I concur. It was a challenge at the beginning getting used to the fact that we're not traveling, and we continue not to travel as a firm. But we have had success. We have adapted to using the various video platforms, and we have signed up some clients without meeting them, which is kind of weird, without shaking hands and breaking bread or having a cocktail. And we're moving to closure on deals totally done online, virtually.
That's what I'm seeing as well. How about you, Christian?
Yeah, I'd say just generally speaking, we've been pleasantly surprised with the amount of our pitch activity and the ability to bring on new clients in the last 6 months. You know, the initial shock of March and April certainly slowed activity to a crawl, but really across industries, we've seen that really pick back up, if not back to, you know, pre-March levels, at least pretty close. And I'd say starting in kind of mid-May, that March has been ongoing. And so certainly, as the guys mentioned, a lot of challenges that are new and that we're navigating, but you know, there still seems to be a lot of appetite from the business owner community to explore alternatives.
Where are you guys seeing the market? Is it heating back up? To me, in my practice, it's really probably in the last 60 days. It seems that more deals are starting to come in to the law side. What are y'all seeing? Is it as far as amount of deals?
Yeah, from our perspective, you know, I think there was maybe a month or two where we saw business owners really more focused internally than perhaps is typical on applying for PPP money, for example. You know, just keeping, in some cases, keeping their businesses' heads above water. You know, I think it was probably July maybe that we started to see more conversations we had ongoing picking back up, responses to our business development efforts starting to pick back up, starting to have more meetings, albeit predominantly virtual. And I think, maybe over the past month or so now, we've started to see the same thing from funds in terms of kind of inbound BD effort on their behalf, looking for deals. So I think slowly but surely we're getting close to back to norm, although maybe the new normal. But I'm hopeful that call it by the fourth quarter here, we start to see pretty robust flow on both ends.
Do you think it's because of COVID, or is it these guys who are going to want to sell anyway, and now they're able to? Things are getting back open.
I think it depends on the situation, and I think it may be Ira's shop that does some distress work, and I think that probably has kicked up because of COVID specifically. But I think it's, at least in our experience, it's more so people that were already thinking about it just coming back up for air, and it's a logical time to do it. Call it post Labor Day to kick off marketing a deal. But certainly there are those that got a shock from the past 6 months, and it's spurring them to do something. I think those that are thinking they want to do something more so because of political election risks or otherwise are probably too late to do that at this point. But we've certainly seen some of that.
Yeah.
Broadly, what you're seeing, John, is, and I'd agree, we're hearing anecdotally as well as seeing in our practice, as you say, things heating back up. I think there was a big backlog of deals, and before those were put back on track, or before those were initially brought to market, both businesses as well as their advisors wanted to see kind of real impacts of the initial shutdowns. And then, hopefully show at least a few months of them coming back to some sort of normalization. And so what I think we're seeing now is that backlog, you just have a huge deluge of deals now either coming back alive or being brought out for the first time, after some of that recovery has been borne out over the last couple of months.
We track transaction volume since COVID started. On our website, you can go and see, we track 11 different industries and all of those industries together, mapping it against what happened last year this time, and as well as what's happening with COVID cases. And what we're seeing is that there clearly was, right after the pandemic was announced and the shutdown, M&A virtually came to a standstill in many areas, but there was continued good growth in some. It seemed that some of those delays, did end up closing, and you saw a little bit of a rise in closings in the summer, surprisingly. But I don't think new mandates were started in that time frame. And now we're starting to see that wave come down. And so closings are starting to trend downward. But I do believe on the other side, though, there was if you could say, hey, what companies are coming to list, you're starting to see those mandates starting to come forward for the different reasons that both Chris and Josh talked about. So I definitely expect some, a frothy December closing schedule and carrying over, but I don't think we're going to get back even to the run rate on a monthly level standpoint that we've had this prior to the pandemic.
Yeah, we saw a bit of a slowdown at the beginning as businesses were shutting down and moving to remote as much as they can to remote work. But we're now seeing, a bit of an uptick in activity, and I kind of I think of it as COVID fatigue, where people thought they'd wait this out and see what happens, or hope for the best, and they're realizing that for the ongoing period, this isn't going to change all that much, and they're just saying, let's get going, and starting the process. Deals that we had in the pipeline are coming to closure. We sometimes work on some difficult transactions, and it slowed down a little bit, but now we're seeing almost no difference. Other than the lack of travel, the deals are just getting processed and moving forward to closure.
Well, I tell you what, Ira, I want to get to distressed a little bit later in our talk, but I think from what we've seen in our distress group at Polsinelli, last count, I think it was over 1,000 forbearance on it, on some loans. And so it's coming, a big wave's coming for the distressed world.
I would agree with that.
So, which gets me to the next thing I wanted to talk about. Being in the healthcare space and doing healthcare deals that I do, I've seen one of the big issues lately has been valuations and how to value these companies based on COVID. Are you guys seeing any? Obviously, it's going to be up and down. Some industries are going to be really hot right now, and some are going to be a little bit low, and we'll talk about that as well. But how are you guys seeing the values of these companies?
I think what we're seeing in the valuations are, we haven't seen any decrease in multiples. Well, if there's been a decrease in value for a company, it's more because their earnings have decreased and people have decided that COVID has had a permanent impact on their operations. So if we can say, hey, this was a dip and it's because of a 30-day shutdown because of the manufacturing plant, but now they're manufacturing just as fast as they were beforehand, people will discount that gap and not hurt the valuation. And again, multiples to us, in some senses, we're seeing maybe a little bit more because there isn't that much product on the market for people to buy. So there's almost a sense of it's a seller's market a little bit if you have a good company and people feel it's somewhat COVID resistant.
Yeah, I would concur. We're not seeing a big difference in multiples from, say, January, February to now. Unless the company is having issues because of COVID that may not resolve in time, there is downward pressure, and the buyers are looking for bargains. They see it as an opportunity to probably pick up some good assets at a somewhat discounted price.
Yeah, I've been seeing the same thing. I think there's certainly quality assets are at a premium right now, and COVID hasn't helped that issue. It's not a new issue. I think the market has been so good now for so long, with the exception of the past 6 months, that this was a problem that's just being exacerbated. So pricing is good for quality assets as it has been, but certainly for those that have been hurt that still either want to do something, whether it's a disconnect between founders' interests and a process making sense at this point, there would be an impact from a multiple perspective there, and I think it may have less to do with multiple and more to do with the number that the multiple is being applied to, because a lot of these businesses have had soft years and thus will have soft year-to-date numbers and trailing numbers for sure. So I think, to Michael's point, pricing is good for the right asset.
I see you nodding, Christian.
Yeah, I'd agree with really what everyone said. I really see it, the limited supply and strong demand piece, I think, is certainly at play here. And so I'm interested to see, as we just discussed, we're seeing deal volume increase. So I'm interested to see over the next 3 to 6 months, if that continues, what impact that will have. But at least today, yeah, we're certainly, the indications we're getting from buyers are very similar to what we would have expected, say, in February.
So once we don't meet the guys anymore, we're doing Zoom calls. We figured out the valuation. I've seen diligence change. What have you guys seen in the diligence of these companies?
Well, let me jump in. I'm not working directly on this transaction, but one of my colleagues is leading the charge on the sale of a small nursing home chain with, I think, 10 or 12 SNFs and some rehab facilities. And the buyer has agreed not to do on-site due diligence, which in the skilled nursing business is kind of unheard of. People like to go through the facilities and see what they look like and get a sense of, just sight and smell, literally. And actually the buyer is an operator, so it's an add-on to their business. But they've agreed to forego on-site due diligence because they're respecting the wish of the seller not to bring extra people into the facility. And they understand that because they probably wouldn't want extra people coming into their facilities. So, that was a new one for us. We had never seen that before. But in talking to some financial buyers, what we're hearing is, because they've limited travel, is they're condensing their due diligence process into one long visit, 3 to 5 days, and they fly the team in by private jet and then just break into subgroups at the target company and do all the diligence in 1 week, all the on-site diligence in 1 week, and then fly home.
We had a similar experience to IRA's with the manufacturing business. We we closed, I think late last month up in Pennsylvania, where the buyer toured the facility by video, and it would have typically been unheard of for there not to be an on-site visit. So I think we're going to see a big emphasis from buyers on how to kind of creatively tackle diligence with a lot of teleconferencing. You might see diligence periods stretch out to figure out how to make that work. But to Ira's point, you may see them condense because a lot of the kind of superfluous or on what was probably now unnecessary travel is being cut out.
No on-site diligence sounds pretty good to me. We unfortunately have not had an instance that extreme, at least to date. But I agree with Ira's sentiment. I think buyers are now trying to condense things to the extent they can limit in person to a couple of days versus multiple visits. That's very consistent with what we're seeing out there.
Are the reps and warranties getting beefed up on these things because of diligence changing? Or are the sellers willing to give more on that side? Have y'all seen?
We've been seeing outside of this is, I think it's being exacerbated by COVID a little bit, but reliance on RWI or reps, warranties, and insurance has picked up quite a bit. I think that's obviously there's more risk associated with doing deals with more minimal or limited diligence, and that's one way we've seen, and we've been endorsing that for several years now, as those policies have picked up in popularity. But that's one way we've seen and have been somewhat reliant on solving that problem.
Ira, how about you on your, if you know, on your SNF deal?
I haven't. I'm not that close to it to see the granularity of the reps and warranties, but I'm sure it's beefed up because of the lack of on-site diligence. But as far as reps and warranty insurance, we always recommend it. We don't do it first go round, but when questions start coming up on reps and warranties, we just say, let's insure it and move forward. And I have a friend who's in that business writing those policies, and he's in the Philly, Southern New Jersey area, and he is pretty busy. So it's clearly the use of reps and warranties insurance, I think, is definitely on the upswing.
That's consistent with what we're seeing and what we've been seeing over the last couple of years. 10 years ago, it really didn't exist that much in my practice, and now it does. Michael, you have anything to add on the diligence side, or?
On the rep and warranty side, we've seen some beefing up, but a lot of times because they can't do the on-site due diligence, if they're buying property, buildings and stuff, you see a little bit heavier reps related to the condition these buildings are in, and maybe create a little separate basket for any for deferred maintenance that should have been happening during this time. But nothing really substantial, and along the lines that everybody else has mentioned.
Right. I'd like to get anybody's thoughts on how the PPP and the small business loans have maybe affecting closings. I know, Josh, you may have a story.
Yeah, I actually have an update as of the last time we talked, John, which was 2 days ago. But the issue that we ran into is in a stock sale situation. You have to get bank and SBA consent on transfer of the loan, because forgiveness at this point is so far out, and that being maybe 120 days plus or minus, but so far out from a deal standpoint that you can't wait around on it. So we've been pushing to try to receive that consent. It's been complicated by the fact that it's a rather large fund that has a portfolio company acquiring the business. And I think the issue that we're ultimately going to run into, and hence the change of direction, is that you start to run into these affiliation rules where now, that although this buyer is a 300 employee business, certainly this fund across their portfolio company has tens of thousands of employees. So, while I think we would have liked to just run and hope that you don't end up with the default and ultimately not receiving forgiveness, I don't think attorneys are going to be able to get overly comfortable with that. Rightfully so, in my opinion. So it looks like in that case in particular, we may end up just paying the loan off. Hopefully splitting it with the fund. But unfortunately, it looks like in order to get something done, it's going to have to be paid off.
Yeah, likewise, I think one of the big problems nationally, the bankers that we talk to, is that even though people are applying to get forgiveness, the SBA isn't acting. So you can apply all you want to, but the SBA is not doing anything with the applications at all. And that's a national basis. That's not a Florida or Chicago or Atlanta. So you are kind of stuck, especially in Josh's case, doing a stock deal. Maybe an asset deal, you might be able to do things a little bit differently, escrow the loan proceeds, off to the side until it shakes out. But a stock sale definitely is going to be more complicated given the liability issues.
Yeah, it's a big issue. I mean, we have 5 deals currently under letter of intent, and 4 of them it's something we're working through. And to echo the sentiment that there doesn't seem to be a lot of urgency from the SBA side is quite frustrating. But I think each situation just has to be kind of managed at an ad hoc basis, and so there's no real kind of playbook that works for every situation.
So in Josh's case, I mean, to get to closing, I mean, you got to close. So you're just going to split it. You think?
It looks like that's what's going to happen. You can't. Unfortunately, we can't sit around and wait for the SBA when it even on the consent side, it could have happened this week. It's possible, but I don't think there's enough certainty around consent rules, let alone forgiveness rules, that the amount of time this could possibly stretch out. Neither party wants to sit and wait on a close, particularly on the sell side, because you never know. It's so hard to get deals done. The longer you wait to close, the more exposure you have to something happening in the business that could adversely affect close. So it's unfortunate because it's going to likely end up costing our client nominally, but we'd rather have the certainty of close and a little bit of a reduction in proceeds.
Yeah, I think people don't want to delay closing, and the trying to get an answer on forgiveness can be mind-numbing. So, and people want to get, and what we're seeing is people want to get transactions closed as soon as possible because they don't want to run into the potential storm after Election Day.
Yeah, not at all to give any sort of legal advice on this call, but I echo Josh's sentiments that it's just too risky due to those affiliation rules to try to get cute with it. I mean, I'm no SBA guy, but I think there's criminal penalties to that if I'm not mistaken. So we need to be careful for sure. Michael, you run up against SBA stuff? It seems like everybody is.
Yeah, and I think it's just par for the course. If your client was on the ball and had a good banking relationship, you got to a loan, a PPP loan. You know, even if you really didn't need it. It's just kind of a safety factor. So I think anybody going to market today, I'd be surprised they didn't have it in their portfolio.
I've been told we've got a question. Sorry, let me see here real quick. How do I do this? How much have we seen earnouts being used to bridge the valuation gaps caused by COVID? Situational examples where it's made a lot of sense.
Yeah, I mean, I could give an example. We tend to, as I'm sure Christian and Michael and I are all do, we tend to avoid earnouts at all costs. They're, I think we always say jokingly, but somewhat seriously, that they're a lawsuit waiting to happen. But you know, because we've seen in some situations businesses that are actually countercyclical and have grown really nicely through this. So much so that, you know, they want, you know, our clients are wanting to sell more forward than perhaps is typical. We've actually been utilizing a little bit of a different tool than an earnout that we're a little bit more comfortable with, which looks a lot more like an equity ratchet, we call it, so that you know, we can use a forward valuation, but to the extent that a forecast is missed, the equity of the equity component of the deal will ratchet down from the target we set it at. So that's just, it's happened a couple of times over the past couple of months, so it's top of mind for me. But to the extent we can avoid earnouts, we like to. It's unfortunately, it's the nature of the beast, particularly with strategic acquirers. But it can be a useful component for sure in those sort of situations.
Yeah, another tool is to possibly put some of the proceeds in escrow, you know, pending the resolution of maybe some open questions.
Yeah, Josh, I just wanted to echo your, I've got a relatively large deal right now that's got an equity ratchet on it. That's how they're working through those issues. Christian, you got it. What about earnouts?
Not so much on the earnout side. What I will say is, you know, we're seeing some, or we have some instances where we're being maybe more creative around capital structure. And so there's one scenario where our client was exclusive with the buyer pre-March, and you know, the expectation was they were going to put X amount of leverage on the deal. You know, fast forward to August, and the reality is they could probably only get 70 to 75% of the way there from a debt perspective. And so, you know, just speaking to both sides, really wanting to get a deal done, we ended up having our client, you know, hold us a note to fill the gap there, you know, allowing the deal to get done. You know, we tried to structure it as such that, you know, with a pretty high, you know, kind of mezzanine level rate to it, so that, you know, ideally, as soon as the sponsor is able to recap that piece out there, they do so, and they're definitely incentivized to do so. So we are, you know, trying to be creative around capital structure, to a lesser extent, ways to bridge the gap on valuation. But, you know, that's just kind of the reality we're in right now, is if you want to get things done.
Michael, you got any earnout comment?
No, avoid them. We just don't play with it. I think the one or two times of the last 5 years that we've seen it, you know, you don't get it. It's too hard, too complicated. Usually by that time the owner's left and is so disgusted, doesn't care.
I agree with that, and I agree with Josh. It's inviting a litigation. I don't, y'all might say it jokingly, but it's true. It's probably true. Which I guess would be good for litigators on the not the deal guys. Let's see, one more quick question. What was the most unique clause that added to the SBA in the past 3 to 6 months? We had a buyer verbally propose a Trump clause, capital T clause, that will execute on LOI barring Trump winning the election.
I could say safely, I have not seen anything that that unique. It's been fairly business as usual. What I have seen is more flexibility on our client's behalf to extend LOIs as diligence is dragged on. But I have not seen any clauses like that.
I haven't seen anything that's been unique, and clearly not that. I think I would definitely run from that LOI.
I haven't seen anything like that myself. What's you, Christian?
We haven't seen that either.
Yeah, no, nothing too interesting to report, at least thus far.
So on that same topic, another question as far as how are the pending elections affecting decision-making for deals coming to market? You know, impacts on taxes, the ACA, tariffs, things of that nature.
A little late now for that decision-making to be factored in, given we're, I guess, a month and a half out from the election. But a little bit earlier this year, we had a handful of clients in our pipeline ask about it. I think the biggest concern we've seen has to do with in the event of a Biden win, what he's been discussing in terms of a change to the capital gains tax that would be in the scope of what he's talking about is, at least what I've seen, is roughly double what it is today. So certainly to the extent that happens, if you were able to get something done this year and pay more like 20% than 40%, that would be of massive benefit. But at this point in the year, you know, barring very special circumstances, it's gonna be tough to get anything launching now done before year end.
Where we see it potentially impacting is in the ESOP realm, where when taxes went down, it had an interesting impact on the valuation process for ESOPs, actually pushed them up higher. So obviously when the taxes do go up, if it happens under Biden, then you're going to see some valuation issues coming up with ESOPs going down. But I think on the margin, it's not going to impact volume.
Yeah, anecdotally, the only thing I'd add is we did have one client who, you know, put timing probably on par with value as far as their priorities, and so we're very interested in getting something done before December 31st for those reasons. And so, you know, that was a process that we've kept fairly narrow, you know, to ideally allow for a speedy process. But other than that, to Josh's point, I mean, at this point, we're too far gone in the game. So
I know your firm does a good bit of healthcare. Was there any talk about the ACA changing or being repealed from your clients? I personally, it just has not been on the radar, and I do like almost exclusively healthcare. It's just not. I haven't heard clients mention it as part of the deal thought.
Yeah, we haven't heard. I haven't heard it coming up either in conversations. You know, I think it's in the back of people's minds, but I don't think they are overly focused on.
You as well, Christian? Jonathan?
Yeah, no, I'd agree. I'm just thinking through. I mean, that really not a big part of the calculus that we've seen.
Same on my end.
That's interesting. That's a good question. In fact, it's one of those things where I do remember in past presidential elections it being more discussed, more on the tax side. And I just, frankly, probably there's so much other going on right now that it just hasn't been as discussed or as top of mind. But I personally have not heard the election being a part of the deal strategy. But that's just me. Was there one more? Yeah. Okay. So, Lena, tell me again, what's our timing? I'm sorry. Was it?
We have about 10 more minutes. If you
10
guys
minutes. Good.
Yeah.
I couldn't tell if it was 12:20 or 12:30. Okay. Guys, for the last bit here, and we may have another question soon, but we discussed the other day, it'd be maybe good to talk about the industries, the hotter industries versus the maybe less hot industries, and what we're seeing of what is closing, what's the appetite for what's hot right now, and how the debt markets are moving.
Maybe I could start, and I'll pick one of the industries we cover. We could bounce around a little bit, but in our coverage of the services industries, I think what we've seen is increased appetite for essential services businesses. Not all that surprising given what happened typically with non-essential services during the downturn, I guess continued downturn in that space. As an example, we've seen a couple of clients in what we call human capital management. It sits in that world. Both of these clients are in the search space. We've seen a lot of interest in quality assets in that space, just because with the increased flexibility of this work from home environment, there's been the ability to kind of broaden, and this is getting very nitty on why this becomes a more quality asset, but with the ability to broaden search from just say Manhattan to now national, given the ability to work remote has become more accepted. I think businesses like that, as an example, will see a nice uptick in not only in sales on their part, but in interest. So it's something we've seen in our services business, coverage. Same could be said in technology and healthcare and in specific corners of that world as well. But I'll leave that to the other guys.
Well, what we're seeing is kind of dovetails with what Josh was saying, is that companies, and I'm healthcare focused, but companies that are somewhat related to telemedicine are starting to get a lot of interest. I've started following the space closely, and just in absolute numbers of patient visits done via some sort of video platform, there was a big spike up, obviously at the beginning, plateaued, and it's dropped a bit now as doctors' offices have reopened. But anything that can augment that space, like patient monitoring devices, data collection systems that can be fed into the doc remotely, has, really piqued people's interest.
What I've found interesting is that some of the assumptions I made early on around where we would see companies thrive or not were way off. So there's, some of the things we've seen have been counterintuitive, at least from my perspective. There's obvious examples of segments that are struggling, and it was clear that they were going to do so, like, you know, anything around event services or anything, you know, typically if you're selling into hospitality. But, you know, one area, we have a building products client selling into the residential market, and in March, I figured, you know, there's going to be a tightening of consumer spending. That's clearly going to have an impact on this kind of mid to high price point good. But as we've all seen, I mean, the home improvement market is on fire. And so I think it's just been interesting from our perspective to see who the winners and losers are thus far. And there isn't necessarily kind of a straight rhyme or reason to it.
Yeah, I concur with Chris on the building products. If you're into the building products going to the residential market, I think you've done well. Probably if you're in the commercial market, there's probably some concern what segment of that commercial market, like office or retail sectors, are I think going to be hurting a little bit going forward. The transportation and logistics is actually on a volume rate that's greater than in 2019. So definitely that sector is definitely getting a lot more attention from a transactional standpoint than some others. The other one that's been really strong is food and ag for us. And overall, if you look at the industry closings, it hasn't had that much of a drop off. In fact, some months has equaled what was happening in 2019. And you would expect that from a food and ag. Although if you're doing the food and you're going into the restaurant sector, you're probably not doing so great. But if you're going to more straight to the retail consumer, you're probably doing very well.
I'd be remiss, Ira, if I didn't ask you a little bit more detail on or we didn't talk a little bit more detail on what you're seeing in the distress space.
Yeah, what we're starting to see is that, you know, folks who were trying to hang on and hope that the storm would pass realize this storm has somewhat stalled, and some people are just starting to throw in the towel. You know, they've used whatever resources they can get, and they're just kind of coming to the end. And we're seeing it in obviously in retail, but we're seeing it in some even healthcare sectors. Worked on a transaction, it's still ongoing, of a small specialty pharma situation that was heavily reliant on their sales force calling on physicians and physicians' assistants and practitioners to detail their products. And they had their sales force could not get in. Well, for one, doctor's offices were closed. So there was a few months that they didn't have any visits. And what's not uncommon now is a lot of doctor's offices, to reduce traffic, are just not accepting visits by drug salespeople. And these companies are small, and they don't have the digital presence or the digital wherewithal that large pharma has, so that if they're not calling on physicians, they could still get their eyeballs on the screen to promote a product. So it was kind of sad, but they just said, we're out.
Anecdotally, I've understood, and this is just rumor, but what have you seen in the SNF space? I've heard a lot of nursing homes are really struggling due to COVID.
They are struggling for multiple reasons. For one, you know, down here in Florida and New Jersey and the New York area, was a lot of deaths. So people are trying to avoid putting their family members into those facilities. What also didn't help is that families couldn't come to visit their loved ones in these facilities, so they would like totally cut off. So people are trying to avoid that. And these facilities have expenses that have gone up because of how they have to now operate in a pandemic. Whether it's, just buying, large quantities of PPEs or, trying to get extra staffing because people are out sick. Just everyday operating expenses for some of these facilities, I think, has gone up. So they're really stressed.
Do you think there's a next wave of SNFs being sold, really to just the major national players?
Yeah, I think there could be. In the SNF deal that we're working on, we got a lot of interest when we started. The way we operate is we don't carpet bomb with non-confidential decks. We actually, people get on the phone and call the targets, and we got very positive feedback and a lot of interest. I mean, it's a small operator, and we got 20 bids.
Wow.
And let's say of the 20, 15 were really serious. Some people were just throwing their hat into the ring just to be in the game, and to try to figure out the market. But, out of 20, 15 were probably serious, which worked out well for the client. But there was more interest than we thought.
I don't want to run over your time. I think we're at 12:30 or close to it. So unless there's any last thoughts or questions, I think we're at time, guys.
This has been great.
Well,
Thanks, Jonathan.
thank you guys so much for joining.
Thank you all. Thank you to our panelists for your contributions, of course, to our attendees and to our sponsors. We appreciate your support. We have had a lot of discussions surrounding COVID and kind of the shifts that we're all seeing from different perspectives. We're going to shift the focus and get a little more narrow and discuss carve-outs in the next upcoming webinar. So stay tuned for those. For those of you that are participating in Deal Connect, you're going to want to log out of this webinar link now and log into the separate link that my colleague Terrence circulated. If you have any questions, feel free to reach out, but we look forward to seeing you all soon. Hopefully sooner in person, but who knows? But until then, stay healthy and we'll see you soon. Thanks, everyone.
Bye.
Thanks a lot.
Thank you.